What we're really excited for moving into 2026 is growth into markets that are moving maybe a little bit more quickly than multifamily real estate. What we're looking at is hospitality, but not just hospitality generally. We're looking at the fastest growing sector of hospitality, which is RV glamping sites. What's unique about them is almost always they're located in prime areas where there's some other added cash flow driver or anchor. So for example, Desert Reef that we just toured in Florence, Colorado, has a hot spring. That hot spring, they pay $5,500 a year for those water rights. They service 20,000 people at $25 a pop minimum at Desert Reef. What's beautiful about that is an absolute anchor to cash flow outside of what they're making for people staying there. So when you find and identify the right location with the right prospects of cash flow, you get this beautiful growth curve. And that happens differently in glamping than it does in multifamily. So this adds diversity, it adds security, and it's a boon for cash flow.
So this hospitality opportunity really complements LeavenWealth's broader multifamily strategy. Why this property? One, just from their underwriting criteria, they're finding places within 200 miles of national parks, so you know that they're going to be heavily trafficked. These are nationally recognized national parks. Two, you have seen an uptick in people buying RV and glamping resorts. As I mentioned, institutions are now becoming much more heavily involved in this. When institutions become more involved, the cap rates will start going down, cap rate compression, which means the values go exponentially up. So we saw this happen in multifamily, it happened in storage. So to be on the front end of this really gives investors a lot of opportunity to see some heavy upside. Third, and this was the first thing I led with before, is the operators themselves. They have tons of experience in multifamily. They've moved from multifamily to the RV glamping space after seeing tons of success in the multifamily side. So they have not only operational experience, but they have deep underwriting, as well as they have gone full cycle on numerous projects. So this isn't just a hobby as many people who get into the RV glamping side are. This is really a larger strategy of finding these assets that are already performing well, but to add their additional business touches to them to make them run even more efficiently with more upside.
We recently got a 52-unit apartment complex under contract in Rapid City, South Dakota, and it is boring in all the right ways. And what I mean by that is it's exciting because we don't have to shoot for the stars. We don't have to hope for higher than average appreciation. It's boring in the sense that it fits every metric we want. It's not flashy. It is very low hanging fruit. We're buying an asset that is owned mom and pop. It's been owned for a number of years. The rent is $200 minimum below market per unit. And through all of our market research, we've been able to see that just at the lowest hanging fruit or the lowest range on the rent that we can increase, you're still bumping the rents $150 a month. And so when I say boring, I mean, we've had other deals that will be successful. We're adding brand new basements, or we're completely gutting a 165 unit complex. This is boring, but it's exciting because it is exactly what we want. It is a 52 unit complex. It's ready to go right now. All we have to do is update the units just to meet the market requests and the market demands, and that's going to be a minimum of $150. We're actually contemplating a $200 bump per unit. And so this allows us to do something we've been doing for years. We don't have to worry about any large ticket items. We don't have to worry about basements or vacant units as far as a whole complex being vacant. We're literally buying something that is very well taken care of. It's a very durable asset. It's been very well taken care of, but it's also in the best part of town. And we're simply updating those units and charging market rents. And so when I say boring, that's exciting to us because there aren't so many metrics and so many levers that we must pull in order to be successful. It is cookie cutter. It is what we do day in, day out, and it's going to be a very smooth process for us because of our experience and how often we've done it. By adding this 52 unit to our investment portfolio, we are furthering the diversification of the portfolio as a whole. We have 180 units in Omaha. We have 126 units in Sioux Falls. We have money into lending. We have money into hospitality, and now we're looking to add a 52 unit in Rapid City. So it really diversifies that entire portfolio. And the way we're approaching each asset is slightly different, but that's good because that means we're diversified. So I think what's really important to highlight here is that month in, month out, we're continuing to find good deals that meet our metrics, add those to the investment portfolio, which ultimately helps the investors.
What's really critical for our investors to know as they move into the 2026 tax year is bonus depreciation is still in play. So your depreciation is accelerated and much more powerful than it would be in other years, which just increases the fuel to the fire of growth that we're going to experience in the multifamily sector. So again, now is the time to invest in considering how powerful and transformational that depreciation is. You're just able to recycle and invest more capital in a shorter, more compressed time frame. Some other things to look forward to in the 2026 year is as we hear about rates precipitating down from the Fed, there's a lot of factors that we're evaluating constantly. So we're hopeful for some potential refinance cycles to happen in this next year. So as an investor, what that means is be ready to have conversations about what your plan is with that capital. So as we recycle that capital back to you, there's opportunities to reinvest. And during this growth cycle, that's something you want to take advantage of and be prepared for.